For better or for worse, everyone's talking about silver. Believe it or not, the precious metal was the best performing asset class last year, climbing past $100 an ounce for the first time in history, before crashing roughly a third in just a week and a half as 2026 began. Gold has led the headlines for the past 4 years, the go-to safe haven during uncertainty, but last year silver, platinum, and palladium stole the show. Investors were drawn to these metals not by accident. They were pulled by a perfect storm of geopolitical tensions, US dollar weakness, and attractive relative value compared with gold. Gareth Soloway emphasizes that while screens show a brutal sell-off, what's happening behind the scenes tells a very different story. Industrial demand is rising, Asian and Indian buyers are aggressively accumulating, and supply constraints are tightening the market in a way that could shock anyone still watching the price charts. Even before last year's rally, the supply-demand story for silver, platinum, and palladium was compelling. Robert Minter, Director of Investment Strategy at Aberdeen Investments, explains that silver and platinum have been in supply deficits for 5 and 3 years, respectively, meaning demand outstrips what the mines can produce. Unlike the last commodities cycle from 2000 to 2015, which was largely driven by China's industrial expansion, today's cycle is defined by structural limitations. Gareth Soloway points out that these bottlenecks make the market fundamentally different from anything seen in recent decades. Even if prices spike, supply cannot simply respond overnight, creating a pressure cooker effect that could lead to unprecedented market moves. Precious metals, after such explosive gains, always spark questions about their long-term role. Gold remains the cornerstone, steady, reliable, and a hedge against economic uncertainty. Silver, however, is far more complex. Known as poor man's gold, it behaves as a monetary proxy in times of uncertainty, but is also driven by industrial demand, now surging from electronics, solar panels, and AI semiconductor chips. Platinum and palladium, while smaller markets, are critical to industry and increasingly constrained by supply. Gareth Soloway warns that while gold may continue a steady climb, silver, platinum, and palladium are positioned for extreme volatility, and the recent sell-off could very well be the calm before an unprecedented storm as demand in Asia and India continues to ramp up. The question now is whether the Western paper market is prepared for what's coming, or if it's about to be blindsided by a wave it cannot contain. Before we jump in, if you appreciate these deep dive market breakdowns, please take a moment to like the video and subscribe. It helps this analysis reach more people while it still matters. I'd love to hear from you in the comments.
Gold had the big flush, but notice again, it's basically all the way up here versus silver is still just off of its recent lows, right? And the reason for that is because there is fear out there in the market building. Even though we had a rally on Friday, and by the way, gold went up on that rally too, which tells you it's somewhat still a risk asset. There's still central banks buying, governments are buying, and retail still doesn't trust the financial systems. And that's more gold. Remember, gold is the pure play for safe haven asset. Silver is a pure play. Well, it's a 50-50. It's a safe haven, but also industrial metal. And we did get some poor jobs data this week. The JOLTS numbers, right? We also had jobless claims spiking up. And then we also had the challenger job cuts, the highest January cut in jobs since 2009. Those are all signals of trouble brewing. And that is not good for silver, obviously. Okay, so what we have here is, number one, the support level has held here beautifully. This was the first support zone right here. We have this area right down here, and you can see how we have areas from this former pivot, and that brought it there. And then we also have a trend line that goes all the way back here, and I'll show you guys this one. And again, I'm trying to pinpoint this one right in here, right? And so you can see how this trend line, it started right here back in September, bounced all the way up, hit, and then hit one more time. And then we had the blow off top. And by the way, this is very classic of kind of a topping signal in the markets where you get this parabolic move where people are like, anytime people look in astonishment at a chart move, especially gold and silver, chances are it's getting close to a short-term, midterm top. Now, long-term is different, right? I mean, because 2011 was a major top, but obviously it wasn't long-term because we've taken that out at this point. So midterm is more the appropriate term for that. Now, again, gold, what are your levels on this? So number one, your obvious level here on gold is right down here, right? So 4,500 to 4,400, that is your key support level. If it breaks that, you're probably going to 3,900. And eventually, the worst case scenario that I have priced in would be back here. Look at all of these pivot highs right through here where there's major technical levels until we broke out. So this here, which is right around 34 to 3,500, that would be where I would buy my long-term holdings in gold. Okay. Up until then, I'm not interested. Now, listen, to be fair, I have long-term holdings on gold already. So it's not like I'm not exposed. I'm just not willing to put more in unless we get back to about 34 to 3,500. Now, on the upside, we clearly have resistance right in here. You can see the high of this day here last Wednesday is the low of this kind of doji candle right there. And that, my friends, is a very good signal of resistance. That's just above 5,000. If we can take out 5,000, you retest your high. So we've now talked about the major support. The resistance level is right here, okay, at just about 5,100. If we can get through 5,100, we should go test this 54 to 5,500 zone right up here at all-time highs, and vice versa. If we start to fall, eventually you get here. Now, what's my perception on this? My perception is that just like silver, eventually gold does break lower, and it does eventually get back to this level. But I think that is your long-term base now. Now, listen, I could be wrong, and I've been wrong many times before, in all fairness. But ultimately, I'm playing off the charts, which gives me probabilities. And so all I care about as an investor is, am I right more than I'm wrong? If I'm using probability assessment, then I need to be right more than I'm wrong by a decent margin, and that I am. Doesn't mean I don't have ones that are wrong, because that's the nature of probability. Sometimes the lower probability works out. All right, let's go on to a couple of the charts. Look at Palladium real quick here, folks, for you. Palladium, take a look at this chart. This is pretty remarkable. I have my lines on this already. That's okay. We obviously have major support. What's our major support? It's right here. Let me bring this up right here. And you can see again how we have this up ascending trend line here, and then this pivot top right there, and those meet right at 1,600. So 1,600 is your level. If you're a bull, you don't want to see 1,600 break. If it breaks, you're headed back to 1,350 to 1,300. That is my buy level on a physical basis. I will start to accumulate. I won't accumulate as aggressively as gold or silver, because this is a much more, even more volatile generally than silver. But nonetheless, this would be my beginnings of my longer term holding accumulation. It would also probably be a great swing trading level as well for a snap back. All right, upside resistance, obviously double top, but we also have this unique ascending trend line that if we were to break the all-time highs, this would now be your next resistance around 2,200. Let's look at platinum. Platinum, see what platinum's got going on for us. Platinum, guys, again, for me, you can see very similar to silver. Silver broke the recent lows, but then bounced back. Look at this level on silver, folks. It's a great technical support. We have this level right here. All right, so very clearly, we have support right in here. You hit it here, here, and then you pierced it, but recovered. So right now, 1,900 for bulls. You got to hold the line at 1,900. If it breaks 1,900, the obvious, and this is a very easy one to see, the 1,690 to 1,700 level, this pivot high, this area. Notice the bull flag right here before the breakout. That's your next level at just below 1,700. All right, on the upside, you got to take out this high right here. The problem is this, is you have this, so there's multiple steps getting back to all-time highs. 2340, that pivot high has got to be taken out. If that gets taken out, you still have to deal with this at 2,500. High pivot, high pivot, high pivot, and right here, that's your next resistance. If it gets through there, then we're talking all-time highs. So platinum has a little bit more work to do on the upside, a couple more levels to get taken out before it can retrace for that. And same thing like gold, silver, and platinum and palladium, I would generally favor in the midterm, even though near term, and I want to be clear, near term, the charts have held support, so they're favorable to the upside. Longer term, or I should say midterm a few months out, I expect lower prices on pretty much all of these commodities.
For years, Michael Oliver has been highlighting one core idea. The silver market is not following conventional patterns anymore. When prices stumble during a surge, it's rarely a sign that the bull run is over. It's part of the rhythm of a market breaking free from decades of suppression. Historical surges show that mid-cycle pauses are natural. Back in the late 1970s and again around 2010 to 2011, silver experienced temporary slowdowns, even as larger multi-month surges were unfolding. These interruptions were not failures, but moments where the market paused to absorb momentum, allowing the next leg to begin even stronger. Observing this, Oliver emphasizes that trying to trade these stumbles can be counterproductive. This is an investment-grade move that rewards patience more than tactical selling. He points out that recent drops in silver, though sharp, should not be interpreted as a reversal of the bull trend. The speed of corrections today is faster than in past decades, but that doesn't change the underlying dynamics. Exiting too early carries its own risk. The gains that lie beyond a temporary pause often far exceed the profits captured by a premature sell-off. For investors, the key question is whether they are focused on avoiding short-term volatility or committed to the long-term opportunity. By mid-year, Oliver suggests, a large portion of the anticipated upside for this cycle could already be realized, making the current corrections a natural part of a broader upward trajectory.
We were looking for a midpoint stumble in our couple quarter surge that we expected to have a couple quarters of massive surge. Back in 79 when that occurred, again within that old $50 range though, and in 2010-11 that occurred. About in the middle of that clock, one was a 5-month surge, one was a 7-month surge. About in the middle, there was a bad month. In the case of 79, it didn't actually close down, but you had a stumble that for about 6 weeks you could have gone sideways after you stumbled. Okay, so it didn't go anywhere. And in January 2011, you had a massive monthly reversal on a price chart where a price guy said, that's a key reversal month, it's over. Okay. The next month, worked your way back up. And what happened on the other side, once you cleared that high, was more massive than what had happened up to that point. So it was a massive move interrupted by a midpoint stumble. We thought that likely would occur more likely, let's say, get into 3 months into the possible couple quarters. Instead, it happened after a month. So we were a bit surprised by the quickness of it. No, we did not call it. We were anticipating such an event probably late February, early March. But now the game's changed. They moved it up. Okay, fine. We still think that's probably your midpoint stumble. That's not the end of this move. Again, we've got too many metrics that are massive in years. Gold versus S&P, silver S&P, silver versus gold. All these things just occurred in November. You don't break out of a decade-wide base and go for 2 months and say, oh, that was it.
Do you ever try to trade stumbles?
Oh, yeah. But in this case, I think this is an investment-grade move in the monetary metals that you shouldn't trade.
Okay.
We've been saying all along that there have been many over the last year, 10 and 15% drops in silver that happened like overnight. Okay, now this was bigger, okay, admittedly, but they happened very quickly. Used to be they'd take several weeks to recoup or a month or two. Now they're occurring rapidly. Look at the October stumble we had, for example. There was a sharp sell-off in October that I think was like a 15 or more percent drop. It took a couple weeks to get out above that. So I don't think this stumble is going to last very long. And the problem with exiting prematurely, even in a thing like this, is when do you get back in? Do you get back in? When do you get back in? And is it better than where you got out? Or if you don't get back in fully, what's on the other side of this is highly likely to be far more gain for you, had you not wiggled, than what has already occurred by our assessments. We think what's on the other side of this is far greater than what's already occurred. So you have to think about it as an investor. Are you in this for the jiggles, even the sharp ones, to avoid? Are you in this on an investment grade? And we're arguing you don't have to wait for years on this either. Highly likely that much of what we're going to get this year will be achieved by summer. A couple months ago, you stumbled in the mid-90s. There was repeated selling, 93, 95. Okay, guys saying, hey, we reached our objective. Right. On orthodox methodology. If you take a logarithmic or ratio scale chart of silver, same time period, you'll see that range from 4 to 50 was like a tenfold the dimension. If you bought the bottom of that range and went to the top, it's tenfold from where you bought it to the top. And it went back up and down, for 50 years. Tenfold on top of 50 is what? Okay?
Gotcha.
Okay, 500. Okay, now you want to take a gold chart, do the same thing back to 75. It's had bull moves that blow out the prior high. On a ratio scale chart of gold, not arithmetic, but ratio, you'll see that both of the prior bull markets, the 1980 peak, the 2011 peak, were 8-fold gains, bear low to bull high. Silver was still capped at $50, but gold wasn't capped at each peak. It was an eightfold gain from bear low to bull high. If we have another eightfold gain, which is merely matching the dimensions of the prior two bull markets, 1980 peak, 2011 peak, you'll go to $8,500.
That's based on the 1050 in December 15.
Yeah, I've put it in a lot of reports, but that's merely replicating an old reality you've done twice in gold. Eightfold, big deal.
Right.
You do it again. Look at the conditions out there, the factors in play, the bond market problems, the Forex problems, commodities asserting themselves again, a new commodity bull, inflation, as many people like to define it. Gold's going to top with a fivefold gain. Okay. So even if we just match that, and by the way, we coming up with that number months and months ago, JP Morgan just came out with the same number, 8,000 to 8,500. We find that curious, but even that's not our target. But in the case of silver, if you do the ratio scale of its dimension, you come up with 500. And if you factor in M2, and I haven't done it, but a lot of people have, you come up with several $100s just to match the 1980 high or the 2011 high when you factor in the decay in the money unit, the real buying power, the quantification of the money supply. Silver, to get back to those realities, would be well in the several hundreds. So we keep coming up with numbers that say, hey, and we looked at copper and lead back in the 2005 and 2007 for lead. They broke out of a similar range, and when they broke out, literally in a couple of quarters, they quadrupled in price on their own without help from other markets. They went into a new reality. How come silver was caught in that reality for 50 years? Something smells there, okay? Well, it's saying no more, okay? And it has yet to achieve anything remotely close to what even copper and lead did or to what gold has done over the last 50 years. I think it's about to.
The silver market is signaling a transformation that can no longer be ignored. Deliveries are rising, physical demand is surging, and the assumptions underpinning paper trading are failing. This isn't simply a fluctuation in price. It's a fundamental shift in how the market operates. For decades, the West relied on the idea that most futures contracts would never be converted into actual metal. That trust is breaking down, and with it, the mechanisms designed to suppress price are losing their grip. What was once a predictable, leverage-driven system is now facing a realignment, where availability dominates perception and scarcity drives behavior. This shift is not happening quietly. When physical allocation begins to outpace paper claims, the market's elasticity disappears. Historical patterns show that once control is lost, markets rarely adjust in a calm, orderly fashion. Spikes, gaps, and sharp reversals become the standard. Silver's unique position as both a monetary asset and an industrial necessity only amplifies the risk. Industrial demand, particularly in technology, energy, and emerging markets, is colliding with the growing desire to secure physical metal, creating a pressure cooker effect that could lead to volatility unlike anything seen in recent decades. The pressing question for investors now is whether the market can absorb these forces without triggering a crisis. Are we approaching a turning point where physical demand overwhelms supply and forces a dramatic reset? Or is this a pause, a temporary stumble before silver surges into a new reality? Every indicator, from historical trends to current delivery data, points toward heightened volatility and unprecedented market dynamics. The coming months may reveal whether the Western paper market is prepared or blindsided. Share your thoughts in the comments. Your perspective might help someone else see the bigger picture.